What if I told you there's a simple way to determine the direction of the market so that you don't find yourself at the wrong side of the market 95% of the time? Rick FX here. Welcome back to my YouTube channel. In today's video, I have exciting and amazing content for you guys as usual. If you are new here, you want to make sure you subscribe to this channel. Also turn on the post notification so that anytime I drop a content like this, you'll be one of the first people to watch the videos. Also share this video or this channel with your friends and colleagues so that they can also hop on the wave. Now in today's video, I'm going to talk to you guys in depth about market structure, why it is important, the types of trends that we have, how to identify them, and also how to identify a potential change in trend. So without wasting much time, let's get right into today's video. When we talk about market structure, what are we talking about? I like to simply define market structure as the language of the market. Now you want to understand that we are retail traders. We do not control the market. The market already has its way of moving. So in order to understand how the market moves, you need to understand market structure. That is why I describe it as the language of the market. Market structure will tell you at any point in time who is in dominance. When the market is made up of the bulls and the bears, or buyers and sellers. So at any point in time, you want to know who is really driving the market so that you can also tag along and make money for yourself. As simple as ABC. So how do we identify these trends? Understand that when it comes to the market, there are only three ways of movement. It's either the market is an uptrend, it's in a downtrend, or it's consolidating or moving sideways. Now we have textbook definitions for all the types of market structures. What I'm going to do is to go on my chart and show you practically how to identify these trends. So when we talk about an uptrend, what do we mean by an uptrend? An uptrend can be identified when the market is creating a series of higher highs, higher lows. In a typical market movement, we always have the impulse. As I said in my previous videos, we always have the impulse, the retracement, then a new impulse and a retracement and an impulse. If the market moves in this fashion, this right here can be identified as your first low. This is your first high. And then it uses this level as a new swing low to resume the original trend. So this becomes your new low. But if you look at this low is higher than this previous low. That is why this level is called what? A higher low. If you remember the definition of an uptrend is formed when the market creates a series of what? Higher lows and then higher highs. So we've been able to identify our higher low. What is next is to be able to identify a clear higher high. So a clear higher high will be formed if the market actually comes back to this area and then breaks this level, our first high, to create a new high. So once you've been able to identify a clear higher low and a clear higher high, you can confidently say the market is in an uptrend. It's as simple as that. Now there's another hack when it comes to market structure, or how you can use market structure to catch trades alongside support and resistance, right? So with our understanding of support and resistance, we understand that resistance is any price point above which the market fails to go any higher, and the support is any price point below which the market fails to go any lower. So with our understanding of that, if you want to embed that with market structure or add that to market structure, you want to understand that this level right here can be identified as a clear level of interest or a clear point of interest, indicating that whatever caused the market to reverse from this point could potentially cause the market to reverse from this point as well. That area becomes a key zone for two things. For one, when the level breaks and it creates a new high, it confirms our uptrend. But when that level holds and it starts to retrace, that is a clear level for a resistance to be able to bank on a quick sell trade. So with an uptrend, we assume that a new high has been created, and then the market keeps doing this thing, creating a series of what? Higher lows and then higher highs. The market, after creating this new high, is going to retrace. Now upon retracement, one of the key areas you can also look out for a potential trade is the previous resistance here. So this is how the concept of break and retest comes into play. So price successfully broke this range and then created a new high, but upon retracement, this level can be tested again. So it still makes our previous level a very sensitive or valid zone to look out for potential trade, but this time around as support. So this is a concept of what? Resistance turn support. Look for a trade here for potential buy back to the main trend. So basically, in an uptrend, you want to be looking for more buys than sells. It doesn't mean that you're not going to take sell trades, but anytime you are taking a sell trade, you are much more careful because you understand that that is a retracement, and then it might not last as long as the swing moves of the buy setups. The opposite is true for a downtrend. A downtrend is created or it's formed when the market creates a series of what? Lower lows and then lower highs. Lower lows and then lower highs. So this right here is our first low. This is our new high, but obviously this high is lower than the previous high. That is why it's called what? A lower high. So in a typical downtrend, we are expecting market to come all the way back down, break this previous low, and then create a new low to form that lower low. Once again, just like the uptrend, when market is approaching this area becomes a sensitive zone because this is the previous low, and then based on our definition for a support, we understand that support is any price point below which the market fails to go any lower. So once price is getting here, we can identify this area as a key zone and speculate for a potential buy, ranging or consolidating market. So this kind of market, so in this type of market condition, you can't really tell who is in dominance, because for one moment the market is trending up, the next moment is going all the way back down, having a series of zigzag and whipsaw movements in the market, right? Now there are no specific times for all of these things. This thing can take as long as it wants to take on the market. Now let's talk about the signs of a change in trend quickly, then we can go ahead to the chart and identify a simple market structure. Now when it comes to the signs of a change in trend, we are talking about when the market is changing trend from an uptrend to a downtrend, or when it's changing trend from a downtrend to an uptrend. When it comes to the signs, there are just two types of signs, right? So if the market is changing from an uptrend to a downtrend, one of the signs that it can give you is to create what we call an equal high. An uptrend, as we define it, is when the market creates a series of what? Higher highs and then higher lows, higher highs and then higher lows. So at any point in time, a new higher high should be clearly identified to determine that uptrend or to make that uptrend value. So if the market decides to use a previous high as a resistance and starts to retrace, this right here is a sign of a potential change in trend. I use the word potential because the market, as we know it, can just use any of these levels to retrace and then break this level and create a new high. So once this level is broken, the uptrend is still pretty much valid. Also, they can decide to come and retest these previous lows here, use this level as a support and push price all the way back up and break this previous high. So when it comes to structure, to make your work easier, you always want to mark your lows and highs, your immediate lows and highs, then you are good to go. Now that this is a potential change in trend, when do we finally accept that the trend has changed from an uptrend to a downtrend? So a trend will change from an uptrend to a downtrend when the market comes and breaks our last significant higher low and then creates a new low. So this right here is a confirmation of our change in trend. Then we start to look forward to potential downside of the market, right? So this is just one of the ways that the market can decide to change trends. What is the other way that the market uses to change trend? The other way is when the market creates a lower high in an uptrend. Instead of the market coming back to retest these highs to create an equal high, it decides to create a lower high to start the potential change in trend. For our trend change to be confirmed, this last previous low must be clearly taken out for a new low to be created. Just like that. So there are only two ways to identify a change in trend. The opposite is true for a change from a downtrend to an uptrend. Same way we have for the uptrend, we also have just two ways the market can change trend from the downtrend to an uptrend. So you can either change trend by creating an equal low, where the market, instead of creating a new low, decides to use this level as a support. Once again, we have to identify our last significant high. This becomes a key area of interest in the sense that for a change in trend to be successful, the market must actually come and take this high out to create a new high, and then we wait for a retracement, and then we keep speculating for more buys. The other approach is creating a higher low in a downtrend. So we are expecting market to break this level to create a new low, but instead of at least coming back to this level, it creates a higher low and then starts to retrace. So once again, you look out for this level right here. So if this level is taken out, if we can confirm a typical change in trend, right? So let's take an example on a chart and see how we can identify a typical trend. So we have our first high here, market draws to create a new low, retraces a little bit, creates a new low, a new lower low, a new lower high, a new lower low, a new lower high. It comes all the way back here, creates a higher low, comes all the way back here, uses level as a resistance, comes down, goes back. This right here can be considered as a consolidation phase. So you can see the market bouncing off the various levels after creating our new lower low. So as a technical analyst, all you have to do is to mark your highs and then your lows, and then wait for the market to play within this range. Or you can trade the market using the simple concept of support and resistance, bouncing off this range. But you know that once the market breaks and takes a direction, it informs your decision whether the trend has changed or the trend is continuing. So we have the market creating that clear new low and then pulling all the way back up to retest our previous low right here. So this is what we call the typical break and retest structure that I spoke about in the presentation. So right here you can find an entry for a sell, a continuation. So what do we have now? We have our new low that we want to be broken, which is right here. These are our new low that we want to be breaking. So as far as we are concerned, for the uptrend to be valid, for the downtrend to be valid, this new low must be taken out. So from here, the market traded all the way back down, pulled back a little bit, came and then eventually smashed this new low to create a new lower low, came all the way back up to create a new higher, a new lower high. Now this is where it gets interesting. So right from here, just like we did for the other ones, we mark our new significant low, and then we have this as our low. So as far as we are concerned, for a downtrend to be valid, the market must come down and break this new low. But look at what happened moving forward. The market came here, used this level as a support, and then started pushing price back up. This was a clear sign of a potential change in trend. But once again, we are not going to be quick to conclude that the trend has changed from a downtrend to an uptrend. But then what do? We now have to wait to see how the market plays out. So instead of the market coming all the way up to just break this high to confirm the change in trend, it decides to come back to retest our low. In this case, making this place our last significant high. So the market came all the way back up over here, finally breaking this to create that new high. This right here was the confirmation of the change in trend from a downtrend to an uptrend. So as you can see, right from this point, it's been a series of higher highs and then higher lows. So that is how you follow the market systematically, step by step, to be able to be on the safer side and then know who is in dominance and trade accordingly, right? So there you have it, guys. This is my simple way of identifying trends in the market and making sure that I'm accurate 95% of the time. Now I'll consider this as an introduction to market structure. There are more deeper levels when it comes to market structure, but this is enough to guide you and put you in the right direction. In subsequent videos, I'm going to make detailed videos so that I can show you the other tricks when it comes to market structure. So if you want me to shoot more educational content like this, you want to subscribe to this channel as usual, share with your friends, family. Do what to follow me on all social media platforms at RICK__FX. Click on the link in the description to join my Telegram channel with the Rick FX community. I do drop insane content over there and trade signals from time to time. Also, you want to click on the link in my description to create an account with my recommended broker, Xness. They have good services, fast withdrawals, fast deposits, and they also have tighter spreads, right? So that'll be all for this video. I'll see you in the next video. Peace out.